All right, guys, we're going to get right into it now. So this will be part one of the web series. So why invest? Firstly, we need to talk about something called inflation. So any idea what inflation is? Have you ever heard the term? No, it's fine. So actually, good question. Did you do business or economics at school?
No,
You
I
didn't.
have no experience in that.
So no, you have no experience in understanding any of this.
Yeah.
Those that did business or economics, I didn't do it at school, but you might have already kind of the basic understanding or an advanced understanding of what some of these terms are. But a lot of people I know don't when they start off. I didn't when we started off, when I started off, sorry. But okay, so inflation. So I'm going to give you the Google definition firstly. So Google says it's the increase in price and the fall in purchasing value of money. So
You need to elaborate.
okay, that's fine. So increase in price. So Freddo. Do you know Freddo the chocolate bar?
Yeah.
Yeah. So I know when it like it's a joke I have like with other people, and this is how I explained it to other people. This is how I explained it to our mum. So Freddo was renowned as like this really good chocolate bar. It's very cheap, and it was like, let's say it used to be like 15p, 20p, something like that, right? So it increased in price because of inflation. So it increased to, I think now it's like 35, 40p or something like that.
Yeah.
But then, so obviously there's the increase in price of that kind of item, that chocolate bar, but there's a fall in the purchasing value of money. So as the price increase, the value of money isn't like staying up with inflation.
Okay.
Because of inflation, should I say?
Yeah.
Yeah, does that make a bit more sense?
Yeah.
Yeah, okay. So I like to think of it as, so that's the Google definition, which is right. I just like to think of it, so inflation erodes the value of money by 2% per year on average. So it's eroding the value of money.
Okay.
So as prices go up, it erodes the value of money by 2% on average per year. It's not always 2%, but we'll just say on average, yeah. So if in say year one, say we're going to stick with 2%, okay?
Yeah.
In year one, if something cost £1, then in year two, it would, because of 2% inflation, it would cost £1.
£1.02.
Yeah, exactly. £1.02. You get it.
Yeah.
And so on. So yeah, year three, 2% on top of that, and it'll carry on top and top. And that's why we kind of generally always see rise in price of everything. But so here we're going to talk about, so in 1926 basically when the stock market database was roughly created. I can't remember, I think that's right. It's around 1926 when they collated all that information. I don't know if that's the actual point where the stock market was formed.
Yeah.
But it's definitely somewhere around, and most kind of databases will track back to about 1926. But I say 1926 to 2016 as well, because that's a good 90 years worth of data. It's just a round number, it's quite good. So in 1926, or kind of that rough era, like £1 was worth a lot of money. Then you could probably buy, I don't know, like a whole outfit or a few items of clothing, right?
Yeah.
And now, I don't know, what £1 can buy you what, chips at your local kebab shop or something like that, right?
Yeah.
You can barely buy a top for £1 these days, right? So if we're talking about just in terms of, you know, the price of kind of Freddo and other items going up and clothing going up, but the value of money going down. So what do you think, £1 in 1926, what would, if we did nothing, if we didn't invest it or anything, if you still had that pound, what would you think it would be worth in 2016?
Near to nothing.
Yeah, basically like a lot less basically.
Yeah.
So I think it's rough, the number is like 93, like minus 93%. So it's minus, yeah, if you had £1 in 1926 and did nothing with it, 2016, 2 years from where we are now, it it would be worth minus 93% because of inflation.
Wait.
Okay, so now moving on to that kind of investing side of it. If you had £1 in 1926 and invested it into bonds in 2016, can you?
What exactly is bonds?
So yeah, okay, that's a good question. So we're going to come on to bonds and all those other kind of investment fields in a later video.
Okay.
But just in general, it's an investment type. So yeah, you wouldn't know what bonds is, but so roughly, you would make back like in 2016, you make £1.50. So that's what your £1 would be worth if you invested it.
2 years ago.
Yeah. So but in 90 years, so that's a 90-year difference there.
Yeah.
Your £1 would be worth £1.50. In gold, if you invested in gold, your £1 would be worth about £4.50. If you invested it into stocks, your £1. So looking at this, any idea what stocks would be?
Probably like £10.
Yeah. So you think £10? It's actually something closer to £315.
Whoa.
Yeah, no, it's a bit more surprising, especially when I'm putting these numbers up beforehand. So stocks in general will give you the best kind of return in money, and that's why when we go through the lot, that's why I started with stocks, and that's why I like stocks. But I'm just trying to explain that with inflation, that let's say it's on 2%,
Yeah.
the value of money is eroded by 2% per year. So it's something to keep in mind. These numbers here don't reflect what you would make on a return, because obviously £1.50, well 50p really, in 90 years isn't a good investment at all. So please do take note of that. This is just talking about the concept of inflation. Has that bit like hammered it into you a bit better?
Yeah.
Okay, that's good. And just kind of to finish this video off quickly, I want to talk about also one other thing. So gambling. So a lot of people like hear the word. I'm not sure if you've heard it or have ever thought about it as well, but this investing or the stock market is gambling, and it's better to kind of just save. Just put your money in a saving account or an ISA or something like that, and just to save your money. Have you ever heard that or thought that?
No.
No, you haven't. Okay, so there are a lot of people that think that. They think it's not a good like idea to risk your money. But the thing is, when it comes to the stock market, I've lost about 5%. Just talking about the stock market, I've lost 5% in my 6 years of being in the stock market. Like the way I kind of do the stock market and invest is very kind of safe, and there is a risk side to it, but that risk is quantified by now my knowledge and experience in the stock market, and we'll come on to that later as well. But I think if you've got education in anything, there's not as much risk. The gamble goes down, and we could say the probability of you losing your money goes down, and the probability of you making money goes up.
Yeah.
So that's what we're doing here. Give you a bit of education, pass it on, and hopefully you
I don't gamble.
yeah, and hopefully you don't gamble. All right, I think we'll wrap this one up in this video. Yeah.
Yeah.
Have you had any questions?
No.
Not for now. We're good for now. All right, we're good.
Now.